If your investing strategy places a huge emphasis on earning dividends, then there's a very big chance that you're costing yourself thousands of dollars each year in unearned returns. Over a span of just 5 years, you could easily lose out on tens of thousands of dollars. While dividends can be a crucial part of your portfolio, they should almost never be the center focus. Allow me to explain why. Now, before I get started, if you're new to my channel, I just kindly ask that you please go ahead and give me a follow. I frequently post valuable videos related to investing and finance, and following me lets me know what I'm creating is valuable for you. Thanks so much in advance. Now, here's why you should never make high-yield dividend stocks the main focus of your portfolio. Why do people love dividends? Well, for starters, they provide consistent income. If you have a hefty lump sum of money to invest, then it's fairly straightforward to build a dividend portfolio that will produce monthly or quarterly income for you. For some investors, getting a check in the mail each month is all that they've ever wanted. The second reason that people love dividends is because they're predictable. Stock investing is overflowing with uncertainty, and it feels like you're always at risk of losing money. However, dividends provide investors a glimmer of predictability in an otherwise unpredictable world. It's easy to look at a company's dividend payment history and calculate how much you stand to gain if they continue paying the same amount. While both of these reasons seem like good things on the surface, too much focus on these reasons might actually be what's holding your portfolio back. It's so easy to get sucked down the rabbit hole of calculating your quarterly dividend payments. Unfortunately, doing this is actually distracting many investors from the biggest point. The main reason I say this is because you'll almost always make way more money by focusing on capital gains than you ever will from earning dividends. By capital gains, I just mean that you should focus on growing the value of the stocks in your portfolio. To make a football analogy, dividend payments are like running the ball up the middle. It's usually only going to get you 3 or 4 yards. On the other hand, a strategy focused on growth is like airing the ball out all over the field. Sure, you might not complete every pass, but throwing the ball gives you the potential to score way more points over the course of the game. There are 3 reasons why a growth portfolio is almost always superior to a dividend portfolio. First, dividend payments are capped. By this, I mean that once you do the math and figure out how much you'll make in dividends during the year, there's basically no opportunity for you to earn more. Second, dividend payments are only raised by a tiny amount every couple of years. That is, of course, if they're raised at all. Third, dividends really only create substantial income if you already have hundreds of thousands of dollars to invest. If you don't have a big chunk of money to invest, then your dividend payments will probably be nothing to get excited about. For these reasons, capital gains should be the main focus of your portfolio. To highlight this fact, let's look at a side-by-side comparison between dividend investing and growth investing using popular funds. To put together the following section, I checked out nerdwallet.com and pulled information from the S&P 500 Dividend Aristocrat Fund. The S&P 500 Dividend Aristocrats is an index fund that tracks only the biggest dividend stocks in the S&P 500. They only include companies that have increased their dividend payment every year for the past 25 years, have a market cap of at least $3 billion, and have an average daily trading value of at least $5 million. The main point of the fund is to provide investors with exposure to some of the most reliable dividend-producing companies in the S&P 500. Assuming that you invested $50,000 into this fund 5 years ago, let's see how much money you would actually have made. Over the past 5 years, this fund returned 65%. This means that $50,000 invested 5 years ago would be worth $82,500 today. However, the whole point of the fund is to pay out dividends, so let's see how much money you would have made when we include these payments. I was able to find the dividend payment history of the fund on Seeking Alpha and found out that they paid an average quarterly dividend of 36 cents per share over the past 5 years. This would be an annual payment of $1.44 for each share that you own. 5 years ago, the share price was about $50, so a $50,000 investment would have gotten you 1,000 shares. Owning 1,000 shares of this fund would result in $1,440 in dividends annually. Over 5 years, this would be an additional $7,200 in dividend payments. This combined with the appreciation of your shares would make your investment worth about $89,700 today. This brings your annual return to about 15.8%. Not bad at all. So, is it too early to say I was wrong? Well, first let's see how you would have fared if you had kept that money in an index fund that was geared for growth. This is where the calculations might get a little tricky. It would certainly be tempting for me to handpick stocks that have outperformed the market over the past 5 years and use these to support my argument. I could grab stocks like Tesla, Netflix, or Microsoft, which have performed incredibly well, and insisted that I'm right. However, I don't want to mislead you. Since there's no way to predict which individual stocks will continue to grow at a rate faster than the market moving forward, there is little point in focusing on specific stocks. Instead, I've pulled the returns for a few popular index funds that are designed for high growth. First, the Vanguard 500 Index Fund, which is basically just the standard S&P 500, returned 101% over the past 5 years. This means that a $50,000 investment made 5 years ago would be worth about $105,000. Another popular index is money sign ONEQ, which tracks the return of the tech-heavy NASDAQ market. The 5-year return for the NASDAQ was even larger at 174%. This means that a $50,000 investment 5 years ago would be worth $137,000. I'm sure that you can already tell where this conclusion is just by eyeballing these numbers. Remember that the S&P Dividend Aristocrats Fund turned our initial $50,000 investment into $89,700 with dividends included. This means that you would be $15,300 poorer than if you had invested in the regular S&P 500 and $47,300 poorer than if you had invested in the NASDAQ. And this is just over the span of 5 years. If we were to increase the timeline to 10, 20, or 30 years, these differences would get much bigger. Boom. That was my mic drop moment for this video. Hopefully giving you an extra 47.3 in the bank was worth you hitting the like button below. Please, I would appreciate it. Now, before we part ways, I just want to reiterate how massive these differences are. If you opted for the dividend-focused index fund, then you would have made $47,300 less than if you invested in the NASDAQ. Plenty of people having $47,300 in the bank would be life-changing. This is money that can be used to put a down payment on a new house. It's enough money to send your kid to college. It's money that you could borrow against in order to open a business, all because you chose to think about the long term when investing instead of getting mesmerized by short-term dividends. What's even crazier is that both of these other funds also pay out a significant dividend payment. I didn't even feel the need to include them in the calculations since the difference in returns was already so big. However, it's not even like you wouldn't get any dividend payments at all by focusing on growth instead of dividends. This is why it's so important to focus on growth over dividends. Okay, I don't mean to bash dividend investors, and like I said at the beginning, investing strategy is something that will be unique for everyone. If you've worked out a strategy that employs dividends in a way that works with you, then that's fantastic. Investing is a tool that should be used to enhance your life, and if dividends are filling that role nicely, then there's no reason to change it. However, if you're interested in maximizing your long-term gains, then the evidence is pretty clear that a growth portfolio will always triumph over a dividend portfolio. If you disagree, please comment below and let me know your thoughts. I always enjoy hearing different perspectives. Really, I do. If you found this video valuable, please be sure to follow the very first link in the video description below and subscribe to my newsletter. By subscribing, you'll receive my most valuable tips for investing, any potential stock picks that I come across, and more informative content similar to what you've just watched. Most importantly, I don't believe in sending automated emails or spamming my subscribers. Instead, you can trust that each email that I send will be filled to the brim with valuable information that's sure to make you a better investor. Thank you so much for watching. I appreciate it, and we'll see you next time.